Welcome to the deep dive. Today, we're cracking open the world of quantitative trading.
Sounds good.
Forget gut feelings, whispered tips we're talking about. Lightning fast decisions driven by algorithms.
Hidden patterns, complex analytics.
Exactly, and predictions powered by these really sophisticated models. Our guide is the book Quantitative Trading by Guo and colleagues.
That's right. We're going to explore how this, pretty intricate approach uses algorithms, data analysis, optimization, basically math and computers to navigate the markets.
It feels like a whole different universe compared to how things used to be done.
It really is. And understanding that shift is, I think, key to getting how it all works now.
Reading about the early days, it's like watching an old movie. Trading floors, shouting, hand signals.
Right. And those stock tickers.
Yep.
Amazing machines clattering away, printing out prices and volumes.
Hard to imagine now.
And think about the friction back then. The book mentions out trades.
Ah, yes, the errors.
Exactly. Discrepancies in the trade details. Someone had to manually sort all that out. Cost time, cost money.
And exchanges even fined firms if they had too many.
Right.
Sort of an inefficiency tax.
Precisely. Which really highlights one of the huge advantages of today's electronic systems.
Yeah.
Accuracy, fewer errors, much lower costs associated with them.
Absolutely. So fast forward to today. It was like night and day. We've got specialized software running on, regular computers all connected online.
And exchanges offer a couple of main ways in. There's the GUI, the graphical interface.
Yeah, what most individuals might use.
Right. And then the crucial one for serious players, the API, the application programming interface.
That lets firms plug their own systems right in.
Exactly. Their own powerful, custom-built trading systems.
And the investment in this tech is just massive, isn't it? Buy side, sell side. Everyone's pouring money into it.
Oh, it's a huge technological arms race, constantly upgrading, building faster, smarter systems. The old image of traders and pits, it's mostly gone in major markets.
Which brings us right to the core. Algorithmic trading. Or algo trading, automated trading.
Yep, different names, same idea.
Using these computer instructions, these algorithms, to automatically place orders on electronic platforms.
Driven by very specific rules about timing, price, quantity.
And it's everywhere now, isn't it?
Yeah.
Not just some niche thing.
No, not at all. The book makes that clear. It's standard practice for mutual funds, hedge funds, big institutions.
Even the sell-side firms making markets.
Oh, yeah. They're generating and executing orders electronically, too, for the most part. And then, at the super fast end, you've got HFT, high-frequency trading.
Which is like a specialized subset of algo trading.
Exactly. Very intense, very fast.
It's amazing. The book says back in 2006, already a third of EU and US stock trades were algorithm-driven.
Shows how fast it took hold.
And this whole tech revolution, it seems like it's also changed how we think about market efficiency itself.
That's a really key point. The book touches on this shift away from the classic efficient market hypothesis, the EMH.
The idea that prices reflect everything instantly.
Right. Which, in theory, leaves no room for easy profits or arbitrage. But quant trading is kind of built on the idea that, actually, with enough computing power and smart analysis,
You can find those tiny, fleeting opportunities.
exactly, those little price discrepancies, arbitrage chances that might only exist for milliseconds, technology lets you spot them in act.
Okay, so let's dig a bit deeper. The book gets into some specific applications. One area is managing portfolios over time, especially factoring in trading costs.
Right. It mentions the Samuelson-Merton theory as a sort of baseline for multi-period investing.
But the real practical challenge comes with transaction costs, yeah.
Absolutely. Those fees you pay when you buy the book, calls it lambda, and when you sell, mu.
Like commissions, essentially.
Yeah, think of it like that.
Hmm.
Lambda for buying, mu for selling. Every trade chips away at your returns.
So it changes the decision-making process. You can't just trade constantly without thinking about those costs.
Exactly. It directly impacts your position, your net worth. Which leads to this really interesting concept, the no-trade region.
Okay, what's that?
Well, with costs involved, it's often not optimal to rebalance your portfolio the instant it drifts from your target.
Ah, because the cost might outweigh the benefit of that tiny adjustment.
Precisely. So there are these sort of invisible boundaries, buy and sell thresholds. You only act when the price hits or crosses one of those lines.
Makes sense.
But figuring out exactly where those boundaries should be, analytically, it's usually super difficult. You often need numerical methods, computer simulations.
That's just complicated fast.
It does. Though apparently it simplifies a bit if you assume a really, really long investment horizon, almost infinite. But the core idea is crucial. Costs introduce inertia. You don't just trade nonstop.
Right, you wait for a move big enough to justify the cost. Okay, another area the book dives into is the econometrics of transactions, looking at the high-frequency data itself.
Yes, this is where it gets really granular. Understanding the nuts and bolts of trading on these platforms.
High-frequency econometrics, they call it.
Exactly. And it really took off because starting around the 80s, we started getting access to incredibly detailed data. Bid prices, ask prices, tick by tick.
Better quality data over time, too.
Right. So this field is all about applying statistical tools to this super fine-grained data to model how trades actually happen.
And the central piece of this is the limit order book, the LOB. Can you sketch that out quickly?
Sure. Think of it like a live digital list for a stock. One side has all the buy orders, the bids, ranked highest price down.
Okay.
The other side has the sell orders, the asks, ranked lowest price up.
Got it.
And a trade happens when a bid meets an ask, basically, or when someone places a market order that just takes the best available price right now.
And the HFT strategies are often trying to predict what happens next in that book.
That's a big part of it, yeah. Analyzing the LOB data, the flow of orders, cancellations, trades to anticipate the next price movement or the next transaction, watching every flicker.
Like reading the market's immediate intentions from the order flow. The book also mentions some pretty advanced stat stuff, like estimating quadratic variation.
Yeah, that gets a bit technical. Quadratic variation, or realized variance, is basically a way to measure the actual volatility over a period using that high-frequency data. All the tiny up and down ticks summed up, in a way.
So a more precise measure of volatility than just looking at daily prices.
Exactly. It tries to capture the total price path variation. The book notes estimating it for the theoretical efficient price is tricky and mentions things like the 4A estimator as one way to approach it.
Okay, maybe a bit deep in the weeds for now. What about the timing between trades? Intertransaction durations.
Right, that's another focus. How long does it take between one trade finishing and the next one occurring?
And there are models for that.
Yep. The book mentions things like self-exciting point process models, SEPPs. The Hawkes process is a well-known example.
Self-exciting, meaning trades can trigger more trades.
Kind of, yeah. A burst of activity might increase the probability of more activity right after. Think news events causing flurries.
Makes sense.
But what's also key, the book points out, is incorporating a time-varying background intensity. Meaning, the underlying likelihood of a trade happening isn't constant, it changes throughout the day. Markets are busier at the open and close, for example.
Okay.
So modeling that daily rhythm they mention using B-splines for the Australian Stock Exchange data makes the models much better. It's not just trades triggering trades, but also the general ebb and flow of the market day.
Got it. So it combines the self-exciting part with the predictable daily patterns. Then there's the UHF-GRCH model, another acronym.
You got it. UHF for ultra-high frequency. This model, linked to Robert Engel, tries to connect that tick-by-tick data directly to the volatility or variance of each individual transaction's price change.
So volatility at the transaction level.
Exactly. And then you can scale that up to get a more familiar figure, like annualized volatility. It uses models like Armaguard-SH on the price changes between ticks. Basically, zooming way in on volatility.
Micro-volatility feeding into the bigger picture.
Yeah.
And finally, in this bit, realized Garcich models. How are they different from standard Garcich?
Well, standard Garcich models typically rely on daily returns to figure out current volatility.
Right.
Real Garcich models take a more direct route. They actually feed in those realized measures of volatility we talked about, the ones calculated from the high-frequency data.
So they use the high-frequency info directly.
Precisely. The argument is that a single daily return is kind of a noisy, slow signal for volatility. Standard Garcich can be sluggish.
Slow to react to sudden changes.
Exactly. Realized measures give a much faster, more accurate snapshot of what just happened. So real Garcich models can adapt way more quickly to changing market conditions. It's a more complete framework incorporating that richer data.
Okay, so harnessing all this high-frequency data gives a much more current view of volatility and market dynamics. Let's shift gears now to how this stuff is actually used. Optimal execution and placement.
Right, this is the practical side. How do you actually trade using these insights? The book talks about two main timescales.
Yeah.
There's the longer term, maybe days or weeks, for slicing up really big orders, and then the very short term, seconds or milliseconds, for placing individual orders precisely.
And these sort of align with different types of traders.
Roughly, yeah. You can think of fundamental investors needing to break up large positions versus HFTs making rapid-fire placement decisions.
So for the big orders, the challenge is optimal execution, breaking it up to avoid moving the price against yourself.
Exactly. That price movement you cause is a transaction cost, known as market impact or price impact. Optimal execution aims to minimize that cost.
Makes sense. Your buying pushes the price up, your selling pushes it down.
Right. Then, at the fast end, you have optimal placement.
This is about how you place the smaller orders.
Yeah. Market order or limit order. If it's a limit order, at what price? How many orders? In what sequence?
It seems like a trade-off. Market orders are certain, fast execution.
But you pay the spread, maybe fees.
Whereas limit orders might get a better price, maybe even a rebate.
But you risk not getting filled, or the market moving away while you wait. Execution risk, inventory risk.
And the book notes that the rebates and fees differ between exchanges, adding another layer.
Absolutely. The whole incentive structure varies, which leads into a specific model the book discusses for limit order placement.
Okay.
A Markov random walk model for the best ask price, but with mean reversion.
Mean reversion. The idea that prices tend to snap back.
In the very short term, yes. High-frequency data often shows negative autocorrelation. An uptick is slightly more likely to be followed by a downtick, and vice versa.
Interesting.
The model captures this by setting a probability parameter p to less than half. The book cites estimates around 0.35 for liquid stocks.
And how do they use this model?
They use tools like the Bellman equation from dynamic programming to figure out the optimal price level to place your limit order, given that expected mean reversion. It directly links the statistical observation to the trading tactic.
Wow, okay. So complex math guiding those split-second placement decisions. Let's look closer at the market structure itself. Market microstructure and order book dynamics.
Yeah, this peels back another layer, looking at how the exchange matching process actually works at that granular level.
Queuing models come up here.
Right. You can think of the limit order book as a kind of queue, or maybe multiple queues for different price levels. Orders arrive, they wait. Sometimes they get canceled.
Like people leaving a queue reneging in queuing theory terms.
Exactly. And market orders are like someone cutting the line and taking the person at the front, reducing the queue length.
And your place in the queue matters hugely, right? Especially with price time priority.
Oh, absolutely. Best price goes first, and at the same price, first come, first served.
Which drives that whole HFT race for low latency.
That's a huge driver. Being microseconds faster means getting to the front of the queue at a given price level, a massive edge.
The book mentions fluid limits, too.
Yeah, that's a more advanced concept from queuing theory, using continuous approximations to analyze things like average queue length, which relate to order book depth and waiting times.
And there are empirical studies looking at real order books.
Yes, the book discusses one on the Hang Seng Index. They looked at patterns in volatility and order book depth through the trading day.
What did they find?
Well, the usual higher volatility at open and close, but also an interesting inverted U shape for average order book depth during the day.
So deeper in the middle of the day.
Seems like it. And they used models to see how short bursts of volatility affected the flow of new orders coming in.
And any surprising results?
What was interesting was this sort of self-adjusting nature. More trades tend to happen when the book is deep, and more limit orders get placed when it's thin.
Like the market regulating itself.
To an extent, yeah. And they found the immediate impact of volatility spikes on order flow wasn't maybe as dramatic as you might guess. Suggests some resilience.
Interesting. Okay, so all this happens on complex exchange platforms. What about their architecture and the kinds of orders traders can use?
Right. The book gives a sketch. You have order gateways like CME's iLink, where orders enter the system.
The front door?
Basically. And then the core is the matching engine. That's the brain, where buy and sell orders are matched and trades happen.
And for HFT, collocation is key, placing servers right next to the exchanges.
Absolutely essential for minimizing latency, shaving off microseconds by being physically close.
And exchanges have to offer that fairly.
Generally, yes. Equal access is important, often standardizing things like cable lengths to keep the physical latency the same for everyone co-located.
Okay. Now, beyond simple market and limit orders, there are more advanced types. The book mentions midpoint peg orders.
Yeah, MP orders. They aim to trade exactly at the midpoint between the best bid and ask. They're often hidden, not fully visible, and they automatically adjust their price as the midpoint changes. It's a passive strategy trying to capture that middle price.
Clever. What about iceberg orders?
Those are for large orders where you don't want to show your full hand. You only display a small part, the tip of the iceberg.
And when that part trades?
It automatically posts another chunk of the same size from your hidden total quantity. Keeps replenishing.
But each new chunk loses its time priority.
Often, yes. The book notes each replenishment might be treated like a new order in the queue. It helps hide size, but has that trade-off.
Smart. And finally, post-only orders on NASDAQ.
Right. These are mainly for liquidity providers, market makers. They're designed not to take liquidity.
How do they ensure that?
They'll only execute if placing the order would add liquidity, go onto the book, and potentially earn a rebate. If placing the order would immediately trade against an existing order, taking liquidity and likely incurring a fee, the order will instead automatically reprice itself, usually one tick away, so it rests on the book instead of executing.
So it guarantees you're adding liquidity, not removing it, helping to capture those provider rebates.
Exactly. Especially useful if your view of the market might be a tiny bit delayed, prevents accidentally hitting a bid or lifting an offer you didn't mean to.
These advanced orders offer some serious precision tools. Okay, we can't talk about this without touching on regulation and risk management.
Absolutely critical. The book mentions key SEC rules, like Reg SHO.
For marking orders long or short.
Yes. And Rule 201, the alternative uptick rule for short selling restrictions after a big price drop, designed for stability.
And the ban on marking the close, manipulating closing prices.
Right, all about fair and orderly markets. But beyond those rules, the book stresses the internal risk management within firms and at the exchanges.
You must be intense for automated trading.
Hugely. Firms need risk officers setting limits, compliance officers ensuring rules are followed. Two big risks. Operational risk.
Tech failures, system errors.
Exactly. And strategy risk. The risk your brilliant algorithm just stops working or loses money.
And exchanges have controls too.
Oh yeah, like the CME limiting message rates to stop systems getting overwhelmed. It's risk management at multiple levels.
The book mentions pre-trade risk checks. Systems checking orders before they go out.
Crucial. Automated checks for fat finger errors, exceeding position limits, compliance violations. Happens in microseconds before the order leaves the firm.
And monitoring the replies from the exchange. Rejects, errors.
Constant monitoring. Need to know instantly if an order was rejected or filled incorrectly. And this idea of atomic book transitions in the data feed.
Why is that so important?
It means each market data update gives you a complete, consistent snapshot of the order book resulting from one single event.
Not partial or out-of-sync updates.
Right. If your system acts on bad or incomplete data because the update wasn't atomic, you could make terrible trades. Data integrity is paramount at these speeds.
Makes total sense. You need a perfect picture to act on. The book also outlines the life cycle of a quant model.
Yeah, it's usually quite structured. Starts with research, idea generation.
Then backtesting on historical data.
Rigorous backtesting. Then simulation, paper trading in a live-like environment.
Testing without real money first.
Exactly. Then maybe small-scale live trading with limited capital. If that works, then full production rollout.
And it doesn't stop there.
No, it's constant monitoring, refinement, adaptation. Markets change, strategies decay. And the book notes tools like R and Python are heavily used for the research and prototyping stages. Very data-driven, iterative process.
Continuous cycle of test, analyze, adapt.
Ah.
Okay, nearly wrapping up. Market safeguards like circuit breakers.
Vital mechanisms.
Right.
The book mentions the NYSE levels based on S&P 500 drops.
Level 1, 2, 3 halts.
Right. And after the flash crash, the SEC brought in single stock circuit breakers too. Pauses for individual stocks that move too fast in a short window, like 5 minutes.
Trying to prevent those sudden drastic plunges.
Exactly. And on the data side, NASDAQ's Total View ITCH protocol gets a mention.
What's special about it?
Fixed length messages, no delimiters, designed for extremely fast computer parsing. Every microsecond counts, even in how the data is formatted.
Speed and efficiency in absolutely everything.
That's the name of the game.
Well, this has been a really illuminating deep dive into quantitative trading, using quantitative trading by Guo and colleagues as our map.
It really covers a lot of ground.
We went from the old trading pits to algorithms, looked at order books, costs, risk, the whole ecosystem.
And it really underscores how sophisticated and interdisciplinary this field is. Needs expertise in stats, programming, data science, finance.
Optimization, definitely.
Absolutely.
So the big takeaway for me, yes, the tech is dazzling, the speed is incredible, But underpinning it all is still a need to understand market structure, the impact of costs, and the absolute necessity of strong risk controls.
Couldn't agree more. Technology enables, but the fundamentals of market dynamics and risks still apply, maybe even more so.
Okay, which leaves a final thought for our listeners. What part of this complex world sparked your interest most? Was it the different order types, the risk management challenges, the math behind the models?
Yeah, maybe dig deeper into whatever caught your attention. There's always more to learn in this field. It's constantly evolving.
Indeed. Thanks for joining us on this deep dive. Until next time, keep exploring.